In the world of investing, discipline is pretty much everything. Today, we're going to look at a strategy from a new player, the Brisbane Investors Group, that might just be a masterclass in it. The source material actually calls their approach sophisticated and brilliant. So let's break down exactly what makes it tick.
Big by name, big by nature. Now, this isn't just some catchy phrase from the source material. It's really a statement of intent. It tells you right away that this group is not thinking small. Nope, they're building a framework that's designed for some seriously significant, high-quality investments.
All right, here's how we're going to break it all down. First, we'll meet the investors themselves. Then, we'll dive right into their core philosophy and the two-layered criteria that's at the heart of their whole strategy. You've got the hard and fast rules, and then a more flexible scorecard. We'll wrap things up by looking at the big picture takeaway from this whole approach. Okay, Section 1. Let's meet the investors. So who exactly is this new force in finance? Well, this is not a group of amateurs, that's for sure. BIG's founders met at the University of Queensland and then went on to build careers in financial services. They've taken all that experience and channeled it into this super structured strategy that, again, the source material calls nothing short of brilliant. So they've got the pedigree, and as we're about to see, they definitely have the plan to back it up.
Section 2. The big philosophy. All that experience and pedigree led them to a core idea, a completely criteria-driven way of investing.
The key word here really is discipline. See, BIG's mission isn't about chasing hot tips or just going with a gut feeling. It's about a methodical, multi-layered process that's designed to systematically filter for quality. This checklist? It's like their North Star for every single investment decision they make. And that brings us to the first filter in their process, what they call the foundational pillars. Now, these are the absolute deal breakers. If a company fails right here, the analysis just stops cold.
And get this, there are only 2 of them, but they are incredibly powerful. First is C-suite confidence. This means a really deep investigation into the leadership. Are there any red flags in their history? This shows a major focus on integrity right from the top. Second, a clean audit report. The company's books must get a clear stamp of approval from auditors. There are no exceptions. This makes sure financial transparency is rock solid before they even consider going any further.
So on to Section 4, the flexible scorecard. Once a company makes it past those first 2 hurdles, it moves to the second layer of analysis. And this is where the art of the deal really begins. The rule here is simple, but it is demanding. A potential investment has to meet at least 7 out of 10 specific criteria to even be considered.
And this is where their strategy gets really interesting. They aren't looking for some mythical, perfect company. They get it. Every business has its nuances. But by setting the bar at a 70% pass rate, they make sure there's a super high standard of quality, while still allowing for the flexibility you need to find great real-world opportunities.
And here they are, the 10 criteria on that scorecard. What's really striking is just the sheer breadth of this analysis. I mean, you've got your standard valuation metrics, like a justifiable PE ratio and a minimum market cap of $1 billion. But then they dig way deeper into the company's operational health, comparing revenue growth to CapEx. Is the company growing efficiently, or is it just spending more? And notice the more forward-looking stuff, a strong economic moat, low reliance on AI hype, and a high reinvestment rate that shows management is all in. It's an incredibly thorough mix of numbers and quality.
Let's just break one of those down for a sec. Revenue growth being greater than CapEx growth. Why does this matter so much? Well, it's a huge indicator of efficient growth. It basically means the company is making more money without having to proportionally jack up its spending on big assets. That is the sign of a healthy, scalable business model.
Okay, here's another crucial concept they're looking for, the economic moat. Just think of it like a castle's moat. It's that durable, competitive advantage that protects a company from its rivals. This could be a super powerful brand, a key patent, or a network effect. It's the thing that gives a company real staying power.
And tied right into that is pricing power. This is all about a company's ability to raise its prices without customers just running for the hills. It's one of the strongest signs you can find of a powerful brand and a durable business, especially when times get tough, like in an economic downturn. It proves that what they're selling is basically non-negotiable for their customers.
So, after looking at the strict rules, the flexible scorecard, and this really deep dive into all the metrics, what's the big picture? What does this whole strategy truly reveal?
And that brings us to our final section, number 5, the big takeaway. What does this all reveal about modern investing?
At the end of the day, this isn't just a checklist, it's a blueprint for discipline. It creates a multi-layered defense against making bad investment decisions. It just perfectly balances those rigid, non-negotiable rules with a nuanced, flexible analysis. And most importantly, it relentlessly prioritizes the quality of the leadership and the financials, and it focuses on finding businesses with those long-term, durable advantages. It really is a masterclass in thorough, principles-based investing.
Which leaves us with a final, really important question. In a market that's so often driven by hype and emotion, could this kind of rigorous, multi-layered diligence be the new blueprint for disciplined investing? Well, the Brisbane Investors Group is making a very, very compelling case that the answer is yes.